Ladies and gentlemen, welcome. Welcome to this TCI week organized by ICISA. You have tuned in to the last item of this Trade Credit Insurance Week. My name is Richard Wolf. I've got the honor to lead the ICISA Secretariat here in Schiphol Airport in the Netherlands. This event's primary purpose is to increase awareness of our industry, the TCI industry. Compared to other classes of business, we're pretty small. However, what we keep on hearing from people as diverse as regulators and journalists is that we are important. We're important to the economies where we live. We're important to the world economy. Now, this week, we had a range of topics, some of them strategic, some of them geographically focused, and some of them with a focus on a single topic. And this is one of the latter category, understanding the re-emergence of political risk and its implication for the trade credit sector. You can ask questions to the members of the panel using the questions button on the lower right-hand side of your screen. Now with this, it's my honor and pleasure to introduce your moderator. Catherine Morton is the head of Trade, Treasury, and Risk at TFX. Catherine is a financial content producer, presenter, writer, analyst, and communicator with extensive knowledge of the world of international finance and risk. She's been in her present function at TFX since January 2018, and she interviews, moderates, and writes on financing, international trade, credit, political risk insurance, treasury, ESG, export, and project finance. Prior to TXF, she had vast experience as chief of the Trade and Forfeiting Review, the TFR magazine, and editorial director at Eurofinance conferences, part of the Economist Group, of Finance Asia, Euromoney, Dow Jones, and Bloomberg's. Catherine has a degree in economics from King's College in Cambridge, and because she has so much spare time, you can understand that after all this, she is also an exhibited artist. And with that, Catherine, the floor is yours.
My goodness, thank you very much indeed, Richard. Thank you, and welcome everybody. So we're here with the re-emergence of political risk and its implications for the TCI sector, trade credit insurance sector. Now, let me be a little bit blunt here. The re-emergence of political risk in terms of this session poses unique challenges for businesses engaged in global trade, and here we're to discover how businesses can safeguard their operations and maintain financial stability amidst a changing political landscape. So let me be a little bit blunt here. Political risk hasn't re-emerged as such. It's political risks in markets where it didn't seem to be before. It's certainly evolved and maybe changed its clothes, and we've got a lot to talk about over the next hour. And we're going to explore this. And as Richard said, if you have any questions for the panelists, please do type them into the question area. And I'm joined here by a broker, an underwriter, and somebody from the arm of an export credit agency and a specialist analyst. So welcome panel, and please introduce yourself, where it is you work and what it is you do. And I'm going to start with Mario Bruni, please.
Thank you, Catherine, and thank you all. I'm Mario Bruni. I currently work in Sace BT, which is the private insurer of the Sace Group. Sace, as you may all know, is the Italian export credit agency. I've been there for 20 years, just joined Sace BT at the beginning of 2023.
Excellent. Okay, so now to Rafael.
Yes, hello. It's really a pleasure to be with all of you today. I'm Rafael Docavo Malvezzi. I'm the Global Chief Underwriting Officer for the Political Risk, Credit and Bond team at AXA XL. I've been part of the XL Kathleen, and now AXA XL team for now 12 years, and I've been in the industry for almost 20 years, and in the general global financial industry for about 25 years. So I've led the team for a couple of years, having held the position of Global Head of Risk for many years as part of the same team at AXA XL. So very much looking forward to the discussion.
Welcome. And Robert Essling.
Thank you, Catherine. Good morning, good afternoon, everyone. A pleasure to be joining you as well. My name is Robert Besseling. I'm the founder and CEO of Pangeo Risk, which is a specialist intelligence advisory, and we provide analysis and forecasts on political, security, and economic risk in Africa and the Middle East. I'm joining you from a very rainy Cape Town today.
Fantastic. Yeah, I forgot to say I'm in Stockholm at the moment, so guest of EKN very kindly. Sian, over to you.
Hi, thank you very much, ICISA, for the opportunity to be here today. And my name's Sian Aspinall. I am CEO of BPL Global. We are a specialist credit and political risk broker. It's the only line of business that we operate within. My own history in the market, I've been in the credit and political risk market now for about 33 years. I've been on both sides of the desk. I spent quite a considerable period of my career on the underwriting side, starting out as a political risk insurance underwriter, and obviously now representing the broking side too. So I have perspective from both sides in the insurance industry.
Fantastic. Thanks very much indeed, Sian. I think actually we if we stick with you, Sian, and maybe we can frame the issue a little bit about what do we mean by political risk in this context, and can it be clearly defined and separated from credit risk in general, and how do political events escalate credit risk?
Yeah, I mean, that's a very good question, because I think we'll go on to expand on that to show that it's a pretty complicated equation. But I suppose if I take a very simplistic starting point with my political risk insurance and insurer background, within the insurance industry, there is an understanding of political risk insurance. That aspect in itself has been from a Lloyd's audit code, which is for PR, which stands for political risk. It very much focuses on two sort of sides of the coin there. It's the impact of political risk on export contracts, and on the other side of the equation within that same audit code, the impact of political risk on overseas assets. So on the contract side, very simplistically, it's referring to prescribed actions or inactions of governments and governmental bodies that result in frustrations of export contracts. So, I mean, name perils on those policies are things like export embargo, export license cancellation, war, currency restrictions, etc., that basically prevent either the exporter or their buyer from performing their contractual obligations. On the asset side, it's focusing political risk in the various forms of appropriation by governments or governmental actions that deprive those companies of their ownership rights in their overseas assets, such as nationalizations of sectors, confiscation, expropriation, etc., and beyond. But obviously that's just an audit code within Lloyd's, and that then spins out into other audit codes which cover whole areas such as political violence, which goes all the way from physical damage due to all politically motivated acts, starting at war, civil war, all the way through to terrorism. So that is sort of political risk in a very, very narrow nutshell, as looked at it from the insurance industry's perspective on that. But that really looks at the micro level, and that looks at the impact of some very prescribed perils, sort of proximately causing a loss on a contract or some assets. I think what we're trying to do today, and I think is a very expansive way of looking at it, is really looking at the interlink between those political risks and credit and economic risk, and to look at and we need to acknowledge the insurance approach, but really acknowledge that in the trade credit insurance space, we need to view political risk on a much wider spectrum in much greater complexity. That it is very much a macro level issue. It's not just a developing country consideration. you only have to look at things like the storming of the Capitol in DC recently, and obviously the very, very topical cancellation of HS2 in the UK, to highlight that we are really looking at a global political risk and not focused, as the insurance industry previously was, very much focused on it being a developing country risk. HS2 is obviously also a good illustration of where the cancellation of that project was driven by economic escalation, or was it driven by political influence, or, as it appears to be, a bit of a mix and a sort of conflagration of the two. And I think that really frames the conversation we want to have today, that the drivers they both drive each other, and that you cannot really look at them in isolation. And that's why having this forum today is very topical, because it really links it back to the impact on a credit default loss at the end of the day in the TCI space. And I think one of the other observations I would have in that space is that if we look at insured exposures in some obviously high conflict areas, or very intense political risk situations, such as an obvious one being obviously the conflict in Ukraine. I mean, the insured exposures in the insurance industry were pretty huge. I think just in the sort of single situation credit and political risk space, we were talking about over 5 billion in Russia, over 2 billion in Ukraine. We're now obviously, and with the impact that will have had on supply chains in terms of oil prices, all the credit pressures that puts on entities within those operations, I think it's very interesting to look at the fact that though these situations are still playing out, insureds are working in partnership with the insurers, and the claims activity has not been particularly high as of to date. Now, there's other reasons for that as well, given state support that's going on in the space. But it does show that those risk exposures are coming down. The claims aren't necessarily going up. So we've got, it's not what I'm trying to highlight is it's not a simple equation here. And I think that is a nice platform for us to have a very open debate about what those trends are, what the influences are, and how political risk then feeds into economic and credit risk and ultimate outcomes. And I'm very interested to hear what my fellow panelists have to say on all of that.
Absolutely, I think that's framed it beautifully. Raphael, if I turn to you, I mean, maybe looking at sort of from a single risk perspective, perhaps, and what the influence is on your business at the moment in terms of from an insurer's perspective.
Well, I think first of all, Shanna has done a fantastic job in setting up the stage and how relevant and intertwined the risks are. No matter which space you play in. Yes, we play more at XXL on the single risk, more medium to longer term. It doesn't mean we don't do short term, but that's our area of focus. But I think our reflections and our discussion is equally relevant to the short term trade credit space, without a doubt. I think that one general conclusion we take is that our product is as relevant as ever. Probably. I mean, that's why we're here. There is political risk, there is credit risk, and it's not getting any simpler. So I think as practitioners and as professionals in this space, it's really our time to shine, if I can say, to be as supportive and as relevant to our clients in mitigating these risks. So we spend a lot of time analyzing them. And I think one important thing is for us is to distinguish between what is a trend and what is a punctual event. Because, we're all well informed, I think, in this crowd. We open the newspapers every day and, take your pick, right? So there you seem to have political risk everywhere you look. Just look here. I'm based in New York, and look what happened in the US Congress just 24 hours ago. I think that it's difficult to evade, but so it's important to make that distinction. And having said that, I think in general, One, and I totally agree with your point, Catherine, that the re-emergence is not exactly the accurate, I think, view around this, but is, let's say, the reshaping, if you want, of political risk that is taking place. And it's quite dramatic, I think, and quite fast, even though the causes, if you want, the root causes, in my opinion, date back to quite a few years ago. But I would say, I mean, as far as the trends, one is deglobalization at large. I think our industry enjoyed a really good run leading up to the global financial crisis. And after that, I think for a myriad of reasons, the consensus around globalization, the expansion of trade and foreign direct investment, what we cover in our business, was a good thing, was no longer the assumption. And I think we live now in a much more multipolar world. The US, or if you want, the Western-based, if you want, consensus around global trade finance and the architecture supporting that is very much put into question. And I think that's, if you want, the root cause, I think, of many of the things we see today. From the resolution of disputes, it's much more, you can see it now, for example, we follow quite closely what's happening with the debt, sovereign debt. Argentina was a case that, it's kind of recurring, but also highlighted how politicized and how, difficult can be those conversations. But now you have the cases of Zambia, the cases of Ghana, and others that might be coming along, Sri Lanka, which have been exacerbated by the pandemic. So I think you have the global financial crisis, and then you have the pandemic, and subsequently, I think in part, as part of that deglobalization trend, the invasion of Ukraine by Russia. It all, I think, spawns in many ways to those days in the global financial crisis, and the lack of appetite, I think, from a lot of Western countries to support that consensus. No more consensus at home for trade support, for free trade. And that has led, I think, in many ways to what we're seeing today, a multipolar world where we have a reluctant United States, a Europe that is not very, it's still looking for, I think, an identity in this area. And, many of the things you see, from supply chain dislocations to relocalization to energy policy, energy security, I think there's so much coming out of that. But I think what's important is to really try to keep track of what is the systemic, if you want, the systemic trends you see that then are the root causes, or if you want, the dynamics behind some of the punctual events that you see today.
That's nice. I like that distinction. Robert, how do you see the picture changing over the recent years? And maybe you can draw out sort of your three top areas. Why now? What's happening now?
It's always three, isn't it, Catherine? The magical number always has to be three. When analysts make speeches, always 3 points. Beautifully, somehow, the world is structured around three pillars.
Ready, aim, fire. That's it.
I think all of us on this panel agree that there is no sudden re-emergence of political risk. Political risk has always been there, but it is shifting and changing, morphing through time. I think, but we have to give some credit to our title, to our theme, because what we do have is that period of flux again. We come from an era, and Raphael was already mentioning this, where we come from an era of globalization, of arguably geoeconomics, where economics underpinned a world order, highly ideological, and where a certain level of certainty and stability could be foreseen, particularly in the developed countries, in the developed world, or the so-called wider West. Hence, political risk insurance was developed, particularly for emerging markets. Now we've gone through multiple shocks, some indeed foreseen, and there, of course, we've had multiple trends lately that have underpinned those movements, but also we've had a number of black swan events, as we call them in the industry, like a pandemic, like a financial crisis or multiple global financial crises, and a major conflict on the European continent. So all of that has led us to, I think the key word is uncertainty or volatility. And that is the main trend. And business does not like volatility. It likes to have certainty. And dealing with political risk can always be managed. Risk can often be mitigated. And business will very often happily continue in politically risky environments. But uncertainty is a far bigger vice, so to speak. I think a second trend that has emerged leads to that lack of ideology that I was alluding to earlier, that the world order is no longer underpinned by a geopolitical ideology of the East versus the West. In fact, it is based upon pragmatism. Couple of examples. In the Middle East, for example, we are seeing phenomenal geopolitical realignment, where a number of conflicts in the Gulf and in the Levant region have cooled, have subsided due to a normalization of relationships, peace agreements, and a resetting of diplomatic relationships. Obviously, I'm talking about the China-mediated Iran and Saudi Arabia diplomatic relations. But also we're seeing a normalization under the Abraham Accords of the Arab countries and Israel, which apparently Saudi Arabia and Israel are imminently going to normalize their own relationships, which may seem normal now in our context, but 3 years ago it would have been unthinkable. That's a realignment based upon natural gas, upon a need to deal with different geopolitical pressures differently, and a drive to look beyond a big oil as a world order. So certainly in the Middle East, we are seeing these trends as well. And I think to fine-tune it into a third point, Catherine, is all of this is happening at the same time as we're seeing a huge economic crisis. We are seeing a sovereign debt crisis, record debt levels, as Raphael mentioned, rising interest rates, surging food and energy prices. And all of this is happening at a time where we're seeing geopolitical tensions and rivalries spike at the same time. That's why we are seeing instability in previously long, stable parts of the world, like West Africa, where long, stable countries are being toppled, mostly because of socioeconomic grievances and hijacked because of political agendas. So those are my three kind of overarching themes. And I think, certainly for Pangea Risk, we've been, getting closely, looking at all of those trends closely and try and evaluate whether they can actually drive country risk in any of these locations.
And we haven't mentioned China either yet. So I think I'll move on to the sort of credit insurance sector specifically. Mario, maybe you can give us a little bit of a perspective from both the export credit agency side and the private side from your point of view. I mean, arguably, export credit agencies could be having a bit of a golden era at the moment, if given the amount of demands upon them.
Until they get the claims. Okay, I can agree on that. Just following up on what Robert said, ideology, geopolitics, geoeconomics, and so on, I totally agree. I mean, in the past, we could say there was some sort of a transitive property, just like in mathematics. If you're a friend of my enemy, you become my enemy, and so on. And you could somehow look at the international platform and more or less foresee where the economies were going to be pointing at. Today is very pragmatic, as Robert was mentioning, and it's just a matter of interest. So geopolitics, it's no longer ideological. So you cannot apply any longer the transitive property. Having had 3 years where we've seen everything we could see, pandemic, war, sustained inflation, food and energy shortage, high prices, and so on. Lately, the wave of immigration, which may have a big impact also in European countries. From SACE's point of view, if you look at SACE's 2023 risk map, it shows a relatively unchanged average global risk if compared to 2022. And we called it a fragile stability, let's say. And maybe this fragile stability was achieved at the cost of public and private debt, which will have some consequences, if not in the near future, for sure, in the medium long term. The main discriminating factor of the few changes in the risk profiles that we've seen are, but not the only one, is mainly linked to energy and food prices, where we see importing economies deteriorating, while exporting economies, just look at the Gulf, improving, Malaysia, Brazil, and so on, with raw materials. So importing countries will not only need to face the increase of prices and of goods and services, but they also need to take a close look at the increase of cost of financing as their debt expires and they need to refinance. This will have a big impact. And the higher cost of external debt will sure have an impact in international reserves. And international reserves that go down takes governments, not always, but sometimes, to exchange control regimes. And this may have a real impact in trade credit, because we may see procedures like we saw in Venezuela some years ago when CADI was set up, where people to import needed to get authorizations and prove to their buyer, and the ECA may be covering that risk, that the authorizations from the exchange control regime entity were in place and so on. So due diligence will become more complicated as well. So this is additional cost for the industry as well. So in this panorama, we can say that we're entering into a weak economic cycle. We can say that mandatory policy decisions most likely will reduce inflation in the midterm, but this will have an increase of risk in the very short term for financial vulnerabilities. I would say that in the middle of a context of high debt, global emerging countries that depend on external financing are therefore very much exposed.
Actually, we've just had an interesting question come through from Akil Madarasu, who says, yes, BRICS influence is now inevitable. What is important to keep in mind while TCI and political risk departments try to accommodate this reality? And this I guess, also kind of highlights some of the currency and convertibility, foreign exchange shortages, the sovereign debt risks, all of these things that you've been talking about as well. I don't know who wants to take that. Robert, Raphael?
I'm happy to give some thoughts on this. I mean, BRICS, of course, suddenly encompassed a far bigger part of the world than previously. I think previously, until the Johannesburg conference, it was it was an organization focused on Asia. And now it's an organization focused on Middle East and Africa. I think BRICS' only major achievement up until the Johannesburg conference was the setting up of the new development bank. It's its own DFI with $30 billion of development funding, which is negligible compared to the World Bank. Up until its expansion. And its expansion takes membership from 5 to 11 members, and it includes some of the world's largest oil producers. In fact, 50% of global oil production is now contained within the BRICS club. Far bigger than its dominance on trade or population or global GDP. And that means that increasingly, the BRICS members will be able to trade within their own currencies. We've already seen this happen with yuan trading for Russian oil, or we've seen rupee trading for food to Russia. But increasingly, we'll see more local currency trading within the BRICS club, particularly for oil. I think BRICS will increasingly become an oil club rather than an emerging markets club.
Nice. Raphael?
Yes, maybe I'll throw a couple of thoughts there that are slightly off. I think BRICS, it's interesting that they adopt a nomenclature that is more Western, but nevertheless, it's a starting point. But I think it tells you, I'm a bit more skeptical about their eventual efficacy and impact. But I think what's important in my view, at least for now, is what it says. And I think it's more the united front of very disparate countries, because you have China and India. China and India are rivals, and they've come to blows quite a few times, and there's a lot of tension in that border. And there's a lot of tension in that relationship for the, if you want, primacy of, the developing world, or this new pole, if you want. We've been talking about a multipolar, deglobalized world. Who is going to take the lead between these two very, very, the largest countries in the world in terms of population, and eventually probably in economic size? So there's quite a bit of, let's say, heterogeneous composition in that group. But I think what unites them is the opposition, if you want, to the dollar, and the dominance of the dollar, and by extension, if you want, the dominance of the West, mainly the United States. So I think it's something, obviously, that we need to keep an eye on. And I think it's interesting, going back to Mario's comment, yes, because all this stress around currencies, this depletion of reserves, the movement has been towards finding alternatives, right? In my view, ultimately, fundamentals are fundamentals. We'll see how far BRICS goes. But I think, to me, the most important signal, it's a symptom of the world we live in that these countries, as disparate as they may seem, are motivated enough to join forces to dethrone the US dollar, if you want. And I think that's the one to watch for. I don't know ultimately what it may become, but I think Robert's assessment, I think, goes in the right direction. But I think it's more, what is it telling us about the current, precisely, underlying competition, if you want, or fragmentation in the world that we're seeing?
Thanks very much. I think that's an issue we might revisit if we've got time. But I think if we move on a little bit to that causality issue that Sean was bringing up at the very beginning, about which events cause specific losses, and let's go down a little bit more into the things like cutting state support after COVID and things like that, just to what the actual insurance market itself is looking like. Sorry, Sean, I was going to sort of.
Sorry, I didn't know whether you were saying sorry. I was pausing too long. I am awake. Sorry, sorry on that. I mean, I think it's as you say, it's a very interesting equation, and at the moment, the impact that we're actually seeing in terms of capacity in the market, in terms of pricing in the market, in terms of claims frequency in the market. I absolutely agree that from looking at the political risk and that interrelation between, obviously, huge economic pressures and pandemic, etc., and the support that had to be put in place from governments behind that, which automatically interlinks those two between political and economic, because they're just then intrinsically bound together. But it's very difficult to talk about that causation issue if you're actually not currently realizing any uptick in loss experience, and because you don't actually then start to determine what has the biggest sway and what is the biggest determinant of the outcome, if currently, from an insurance perspective, the outcome hasn't been realized. Now, everybody's looking at it saying it's a timing issue. It's coming, it's a tsunami, it's coming for us. But actually, the longer it my personal view, and it's only a personal view, but is the longer that takes to come to realization, the more time people have to find alternative means, get used to change, deal with volatility and adapt, that I'd like to give some definitive definitive positions there, but in absence of actually any concrete insurance data to support any of those directions of travel, it's very difficult. And I think from the outside, we would say, I think we all agree that the complexity of the equation at the moment is greater than I think any of us in our, well, definitely in my lifetime to date, I've ever seen in terms of those conflicting sort of impacts. But they're not actually yet, and it may just be yet, so don't get me wrong, actually culminating into increased loss experience. And I mean, I would throw that probably out a little bit now to the insurers on the panel, but that's, I talk to our claims team on a weekly basis about what they're looking at, and it's no greater in frequency and complexity than it was maybe 3-5 years ago, and I would have said those stakes and that complexity have increased dramatically in that period.
Mario and Raphael, you're both nodding. Mario, what are you seeing in terms of the actual size of the market?
It's a difficult question because I think we were all expecting a wave that hasn't arrived yet. And we all wonder if it's just a matter of time or we will keep riding this wave that doesn't get here yet. I think we're reaching the end of state support, especially in Europe. Now we're getting into the repayment periods with higher interest rates, so difficult to refinance. And we will see, as you know, the support mechanism set up by Europe provided that there was a step-up mechanism for pricing. So as we go along with these financings that last, in some cases, 6 years, we will see a higher pressure in terms of cost of repayment. And you cannot refinance, because if you refinance today, you would probably pay more than what you will pay even with the step-up mechanism. So this may have an impact for sure. I think it's a matter of time.
Raphael, what are you seeing, and do you think it's going to have an impact on your capacity?
Well, we will see. I mean, certainly, at least from the private insurance side, absolutely, I think with Sean, I would agree. It's been a really benign period, given everything we've gone through. You would say, we would be paying claims, day in, day out. And for us, we are paying claims, but a lot of it is, it's very much focused on a couple of cases, really. It's the yet to be resolved Ghana and Zambia debt, sovereign debt, which hopefully is coming to a resolution, and how that is going to play out in terms of recoveries, in terms of reshaping of that and restructuring of that debt. That will set, I think, either validate a lot of the assumptions that we take around our business, particularly playing in the, emerging market, sovereign-backed or government-backed types of transactions. A lot of infrastructure investment that is still backed by governments. If the resolution is positive, and the recoveries of the claims that we have been paying and the market has been paying prove to be according to expectations, that is very good recovery potential, then I think we'll be, pressed to reduce capacity if we have, at least in that part of the book, which is quite considerable as a total share of the book. But that remains to be seen. Otherwise, it's true. We've had a number of punctual claims, some wobbles in some of the renewable sector, etc. But I think in general, given all the shocks, it's been a fairly benign period in terms of claims payment. Now, going back to Mario's assessment, I do think, you can see in the credit side, the bankruptcies are happening. Maybe it's more concentrated in smaller, medium-sized enterprises, so the impact is not that big at the moment, but I think it signals a trend. With coming out from more than a decade of really unusual monetary and fiscal stimulus that we've really, I don't think we've seen at least in our lifetimes. And coming out of that, I think the perception of risk, the pricing of risk has been, if you want, anesthetized a little bit. So I think we're in a bit of a reckoning that has to happen, and it will happen. How dramatic that's going to be, I'm not going to be a prophet of doom, but there is quite a bit of uncertainty around that. But so far, I mean, the results, aside from those specific cases, at least for our industry, has been pretty benign. But I wouldn't put my money it's going to be the constant.
Now, I love the question that's just come in from Thomas Frossard. Isn't it a bit unfair to have chosen France to illustrate the emergence of political risks on the picture displayed at the beginning of the webinar, with a slightly confused looking face? I'm just, given the fact that we started our discussion talking about HS2, as it may have never be called, and as it's about to be cancelled, and that the chap who actually coined the phrase BRICS is campaigning to keep HS2 going. I don't think it's just France that's going to be on the highlights on this one. Anyone want to take up anything about French risk?
I can give it a stab. I don't think you should feel pointed at if you're French or live in France, but I think it's more symptomatic that the political risk is knocking at homes that, hitherto weren't the traditional places where you would see political risk. And again, I'm European and I'm living in the US, and I've been here for quite a while, so I have one foot on each side. And frankly, the landscape in terms of risk has changed dramatically. Here in the US, I don't need to explain, but I think we've seen the protests in France. We've seen the lack of support of some of the leaders in the various countries. In many ways, the lack of a direction in policy or a commitment to a vision. It's hard to see where the leadership is. And I think more dangerous is the lack of trust, if you want, in government and generally in institutions. I think you see the weakening of institutions in many countries, and it's not just France, but I think you could have picked Barcelona, or you could have picked, many cities around the developed world where it was an afterthought, political risk. So don't feel picked at. I think that in many ways, it's just one example, but a very relevant one, which in my opinion, we really need to deeply think about and keep in mind.
Right. As we're on the last 10 minutes, we've got quite a few issues still to cover. One of which is we've seen longer production periods leading to longer waiting periods in policies. This is true in emerging markets as it is in the OECD area. Why? And how can this change? I'm not sure who to address that one to, actually, to be honest. But
maybe I can take that one very quickly. From SACE ECA's point of view, we did face this issue during the pandemic because maybe goods could not be shipped because borders were locked. And they had a policy at hand, and we realized that we needed to set up within the policy a longer waiting period for the claim to be called upon. That was the solution that we found to tackle this issue. So the longer production period may be due to supply chains, logistics, and so on. But also to the fact that borders can be closed. And there again, it's a big issue. Is this a political risk that we need to cover in the trade credit insurance or not? I mean, is it a credit issue or is it a political issue? So one of the solutions that some found was to extend the waiting period of the policy before the claim could be called. And in any case, insureds accepted this proposal. Otherwise, it would have been difficult to offer production risk cover.
Great.
Catherine, can I jump in on that one quickly? I think one of the most overused words of the last few years, especially when you switch on the news, is the word unprecedented. Everyone seems to be using it all the time. But I think, again, we at the same time, we are living through unprecedented times and dealing with unprecedented crises. I think, therefore, we have to find new solutions to these problems. And that takes a bit longer, trying to find consensus. And we see it in supply chain. Rafael was talking about debt sustainability, particularly in case of sovereign defaults in Africa, in Sri Lanka, etc. For example, on debt restructuring, we are seeing the IMF and the Paris Club engage with China and DFIs in completely innovative ways through the common framework or the enhanced common framework, and very much on a bilateral level as well. I think what I like, even though it's taking a really long time, and that's certainly not helping with claims management, what I do like is that innovative ideas are coming out of this. And as a risk forecasting company, I mean, we saw Zambia's default coming quite a few years beforehand. Ghana's, probably everyone saw coming eventually. But we often get asked who's going to be next. And without being the prophet of doom, as Rafael mentioned earlier, I think the innovative solutions that are being created at the moment, even though they take a bit longer to be formed, are mitigating some of those potential future defaults, helping to buttress the global economy a little bit more against these types of default scenarios. So I think we all can be a little bit more patient, because we're trying to find consensus, but not going about this in an arbitrary or unilateral way. And that hopefully should get us out of this current unprecedented crisis and make us more resilient for future ones.
That's a good point. I think, I mean, on that note, I mean, we haven't covered certain areas. We haven't covered Latin America. We haven't covered China specifically. Are there any sort of takeaways, as we're in our last 10 minutes? Maybe you give us a few final thoughts, Sean, on what the audience should be. I mean, obviously, trade credit insurance is a good product. What impact political risk has on it as a sort of like a takeaway?
I mean, I think my own takeaway from it would be that realistically you can't determine causation. You can only look at impact, and therefore from an insurance policy perspective, we really should be looking at that overall comprehensive credit coverage that is, because the fact you cannot determine proximate cause, which is obviously an insurance term, but it really determines whether or not you've got a valid claim. So I think all of this points to comprehensive credit cover. Don't look at slicing and dicing causation. Don't really look at what those exclusions are in the policy and how viable they are. I think from our perspective, when we look at things on behalf of clients, obviously we're looking for as simple a comprehensive coverage as possible, but solely on the basis of I don't think anybody can determine causation at the moment. And I look at our exposures, the exposures we had 5 years ago versus today. Now, the shift in the single situation market is to not away from, because I think the exposures stayed the same, but huge growths in developed world exposures. And so I take the point about France being the political risk here, not being a bit of an unfair choice. But I think if you look around the developing countries, there's huge instability coming there. I mean, you only have to look at the UK and the number of prime ministers we had in a very short period of time. And, so I think that might shape the industry as much as anything else, on the basis that what the insurers are now insuring has shifted a lot, but so has obviously the dynamic, So what that will ultimately result in, I think, is currently, I would say, not particularly clear. But what I would say is we need to, solely from an insurer's perspective, focus on impact, not on cause, from an insurance perspective, because I don't think you'll ever be able to determine one from another.
Nice. You know, I'm going to start asking everybody for their 3 takeaways. I've picked out three words so far: pragmatism, causation, unprecedented, and I've added impact. But there we are. Mario, just in terms of your takeaways, what messages do you have for the audience?
Well, I think there should be further collaboration between the private and the public. If you look at volatility, uncertainty, which is increasing, and we have a global crisis somehow, and we will see some impacts in the near future. We need to build capacity, and capacity cannot be just public. In times of in hard times, it has to be a combination of public and private, and there needs to be more agreement. I mean, supervisory entities on the banking sector should talk to the insurance sector as well, so that they can coordinate actions and put these two capacities together, and underwriting and also due diligence capacity together, which can make a difference, because I think there's a lot of expertise also on the private side.
Rafael, from the private side, how do you respond to that?
I absolutely agree with Mario. I think that, and we've been going at it, through the, organizations like ICISA or the Bern Union. A lot of the work that's been done over the last few years is precisely much more. When I first went to a Bern Union meeting, it was public, private. We keep our walls, and we talk to each other at the dinners, but, everybody does their own thing. That's changed dramatically. So I think there's still a lot of work to be done. The regulatory aspect is fundamental, and we know about it. We need the authorities to recognize that to muster, the capacity needed. There is opportunity. I think I'd like to put a positive spin to. There's huge opportunity. There's a huge trade and foreign direct investment gap, a bankability gap to a lot of the flows that and the needs, the demand that's out there for credit and support through insurance, whether it's public or private, and to really muster and to bring together the capital from the private sector and collaborate and go side by side with the public sector wherever we can. Yes, we have different mandates and different guidelines, but we pay claims, and we want to be part of it, part of the solution. So collaboration in that respect is fundamental, because the opportunity is definitely there. So I don't have 3 takeaways, but maybe just something to add a bit of spice to the conversation. We didn't speak, yes, about China or Latin America, but one takeaway, if you look at China, really there's a huge interest in, and there has been, in acquiring strategic sectors in Latin America. There is a, let's say, populist left wave that is very anti-US. So I think that, that's something to watch for. It's more diverging, if you want, motivations, but ultimately, if you want, distracting the US, causing issues, whether it's steering the immigration. It's a huge issue, and also for Europe and linked to the Sahel in Western Africa. There's a big matter there that requires, let's say, creative and consensus solution. And then also crime and drug trafficking are huge challenges that underpin a lot of these things. So 2 things to look at if you want.
Thank you.
In the broader risk.
Yeah, absolutely. I like the fact you're calling it the bankability gap, and we've got 2.7 trillion trade finance gap. So many gaps to be solved with the collaboration of insurers and banks and export credit agencies and multilateral finance. Robert, I'm going to leave the last words for you in terms of your guess how many 3 takeaways. 3 minutes.
I was so entranced listening to the other 3 key points that I forgot to, draft mine. Meantime, I think I've already given you my three points. Yeah. I think we've already at risk of duplication and overrunning on time as well. I think if we're going through a period where political risk is changing, and we're going through a period of uncertainty, I think we all agree that consensus is really important. We've got the Bern Union. It's great that we can be here together virtually with ICISA, and thank you very much for the invitation for putting this together. And there's so much more we can do. Earlier, I mentioned the Paris Club and how it can interact more with different other stakeholders in terms of debt restructuring. But at the same time, the onus should not only lie on multilateral bodies. It should also be, in the end, with the deal makers, and an extra layer of due diligence from the beginning of a transaction really should help with managing and mitigating risk. Reading earlier that we have about trade finance fraud up to the amount of $50 billion a year, mostly because much of it is not yet digitalized. It's an interesting statistic, and it really puts the onus increasingly on driving new technological innovations and driving that consensus model as well. So I think there are multiple different ways, Catherine, in which we can, from our perspective, help manage and mitigate that political risk spectrum.
Fantastic. And on that note, thank you very much, ICISA, and thank you very much, my panelists. What an excellent discussion, and looking forward to doing it again. Thank you.
Thank you,
Thank you so much.
Thank you, everyone.
Thank you, everyone.
Bye-bye.
And I look forward to you doing it again. So from the side of ICISA, thank you so much. Thank you for the speakers. Thank you to you, Catherine, for moderating this expertly. And also thank you for the audience, for your attention, for not dropping off, and for your thought-provoking questions. Now, any questions you might have for the speakers that you think of tonight, under the shower tomorrow morning, put them to us via icisa.org or through the email secretariat@icisa.org. And you can show this webinar to all your friends, family, colleagues. They might learn something. I'm sure I did. All the items of this week's TCI week are and will be on our website. You can find them all. And we will be looking forward to organizing webinars throughout the year. Our next week, as we call them, is the Surety Week, which we're looking to organize in the week of February 19th. It's been a pleasure. We had a full week of eight very distinct topics. Every topic had something in it from which I at least learned a lot. And we're looking to do it again next year, I hope, with an impressive lineup of speakers as we had this year. So thank you all again very, very much. For now, this is ICISA signing off from Schiphol Airport in the Netherlands. Thank you very much.